Good evening, class. We are about to wind up this summer school session, and I thought what I would do for my last video or our last video is we try to help you build the tools that you're going to add to your toolbox, and also those tools are going to make you successful in the future. I'm going to do just a quick review of chapters 5 through 8. If you remember, I did a review of chapters 1 through 4 before your midterm, and I'm going to do a review of chapters 5 through 8. So at least to hopefully help prepare you for your final. And just kind of, I've got several notes here, so I kind of walk through them. Also, just always remember that your production possibilities curve, and it was something we went over back in the earlier chapters. It makes several assumptions. It assumes that all of the factors of production are fixed. It assumes that your factors of production are fully employed, fully utilized. And it also makes the assumption that whomever is making the decision is going to allow the entity or the firm or the economy, for that matter, to produce efficiently. And that if all three of those are held in place and are valid, then it puts the economy, it puts the market, it puts the individual entity on that production possibilities curve, and that allows them, sitting on that production possibilities curve, to reach potential production. And when you go back to the fixed labor or to the fixed factors of production, you've got labor, you've got capital, and capital, you think of capital stock, buildings, machinery, any other kind of equipment. There also, you can throw in there residential capital, so individuals buying new houses, because that's going to provide a asset that's going to function over the long term for maybe that individual and their family. You've got natural resources. The one most people think about is the land that a building's on. You've also got natural gas. You've got gasoline to run vehicles, and then the technology and the entrepreneurship. And it's a technology. When we talk about technology, it's a technology of the production process. So the more efficient the technology is, the more efficient the production process is. And thankfully, most companies have at least an individual somewhere along the way, hopefully it's in senior management, that have that entrepreneurial spirit and are going to constantly look at ways to improve the production process, make it more efficient, make it more profitable. And that's going to actually drive the economy, the firm, the entity, whatever you want to market, whatever you want to talk about, it's going to drive it to that production possibilities curve. And then kind of moving from chapters 1 through 4, we move into the macroeconomic view. And that's what is talked about in 5, 6, 7, and 8. And macroeconomist or macro, the process of a macroeconomist is they're concerned about output, they're concerned about employment or / unemployment, they're interested in interest rates, and they're concerned about price level. So these are all things that they're going to try to tie together and hopefully build out your toolbox to a certain level or a certain degree in chapters 5 through 8. And if you want to start with I think it was chapter 5, where we talked about gross domestic product, GDP. And if you remember, we talked about GDP. It was consumption, it was investment, and again, investments, capital stock, and residential stock. Consumption is ordinarily day-to-day consumptions by consumers. You've got government purchases, which also includes not only just items of government purchases, but it also includes the productivity of the government as it's, within itself. And then we also talked about government purchases. Don't get it confused with government spending, because one of the biggest chunks of government spending may not be true government purchases. It may be more transfer payments, Social Security, Medicaid, those types of transfer payments drive a lot of the overall government spending. But what we're talking about when we're calculating GDP, it's the government purchases. And then we've got net exports, and that's basically exports minus imports get you to net exports. And then we also, when we were talking about issues with calculating GDP that you normally hear the talking heads refer to, Wall Street, CNN business, Fox News business. It's what they call nominal GDP, because what's happening there, it's the summation of all the final goods and services, and it's the quantity at the current rate times the price at the current rate, summed across I = 1 to infinity. And then we started asking questions about, well, how do you tell from one time period to the next whether the rise in GDP is due to actual productivity, or is it some combination? Maybe it's just price levels have increased, or is it some combination of the two? And so what macroeconomists do is they've decided, well, we're going to talk about real GDP. And what happens in real GDP, it's the price, and it's held steady at a base year. 2000, 2010, 2015, whatever the base year is selected, price is held constant at that base year, but it's multiplied by quantity at a certain level. So, and also remember that it's just in the terminology of the macroeconomists, GDP is the market value of final goods and services, and and on the real GDP, we adjust it to eliminate the impact of price changes. In a sense, at least from the macroeconomic perspective, that determines the economy's true output. Once you adjust it for those price levels, that is the closest metric that a macroeconomist, at least at this point in time, comes up with when they're talking about the true level of output. Also, as we started, going through our chapters, we talked about the business cycle. And, business cycle is inevitable, expansion, recession, peaks, valleys. It's variable, somewhat cyclical, but highly risky, highly variable, difficult to, not only difficult to forecast, but difficult even to measure and to determine when the business cycle stopped and ended. And if you remember the diagram in the book, so it showed the curve going through the business cycle. So you're going up one side, and that's the economy is in expansion mode, doing really well. It hits what they call the peak, and then it starts to turn down, and that's when the economy is kind of going through a recession, or at least slows down. So it's coming down through that recession. It hits what they call the trough. That bottoms out on the recession. The economy starts up again, expanding, and hits the next peak. So the business cycle is measured peak to peak. Within that peak, you're going to have recession, you're going to have the trough, you're going to have the expansion again to bring you up to the next peak. So one peak to the next, that's the estimation, or that's the best guess or the best measure of when the business cycle actually took place. And then when we're talking about GDP, they also threw out this couple of concepts of a flow variable. It says it measures something over a period of time. If you own your own house, or own your own home, you might look at the mortgage payments, interest you're paying on your mortgage. That, because the concept is a flow variable. If you're looking at a stock variable, it's a snapshot. It's a point in time. And so the amount of money I have in my billfold, that's a stock variable. My stock portfolio, if I get on USAA or I get on Schwab and I look at, what is the value of my stock portfolio right now, that is a stock variable. That's a snapshot, a point in time, whereas the flow variable measures something over multiple time periods. And again, so your monthly mortgage payment, your monthly car payment, think of things in terms of something that you may be paying over time. So that's their concept when it comes to the definition of those couple of variables. And then we talk about things that are counted as expenditures. And remember, you go back to GDP on the nominal, whether it's the nominal or the real GDP, and that expenditure model. And that expenditure model is the one it's consumption plus investment plus government purchases plus net exports. How do you count things? So the government part of it, it's government purchases or services provided by the government bonds, government USDA provides a lot of services. So it's either government purchases, outright purchases, purchases for military, purchases for defense security, or something provided by government agencies. You're in consumption, the individual consumption and just consumption in general. It's purchasing a final good or service. And then you've got net exports, which we talked about was exports minus imports. And then lastly, investment. And investment it can be either capital stock, as we said, individuals, firms, markets, economies, determining do they purchase capital stock and investment, or it's a homeowner that's going out and buying a new house or a new property. So those are kind of the expenditures and how you measure those expenditures. And one thing just to keep in mind is when you go back and look at the firm, so if you're buying stock in the firm, and we talked about the impact of taxes along the way, if you're buying stock in most firms that are selling shares, New York Stock Exchange, one of the major exchanges, typically most of those are corporations, or maybe they all have to be corporations, I guess, to get on the exchange. But when they have profits, or if they are generating profits, and a decision is made with what to do with the profits, they will either keep some of those as retained earnings, or they'll pass some of the profits on to the individual investors, you, me, your neighbor next door. And when they pass those dividends on, you're going to have to pay personal income tax on those dividends. So with corporations, there's a corporation tax, and then if they don't keep all of the profits as retained earnings, they're going to pass some of it along as dividends to the individual investors, the individual holders of those stock certificates. And so you're going to have to pay taxes on them again. So corporations are, it's called the double ding. So corporations, to make a profit, they've got a corporate tax, pass money on, or in the form of dividends to you, me, as again, neighbor next door, gonna have to pay personal taxes on those. And then they talk about, we already talked about the government purchases. It's items, either bought by the government, buy something, or it's measuring output produced by government agencies. And then they ask questions, or they get into government purchases, versus government spending. And that's where we're talking about transfer payments. And typically on the transfer payments, again, we're thinking things like Social Security, Medicare, EBT cards, that's taking the place of the food stamp service. So those are what we typically think about as government spending. And again, I don't want to continue to beat a dead horse, but GDP only counts the final purchases of goods and services. There is no intermediate sales of inputs. So when you're thinking about, and I think the one they used in the text may have been maybe as a logging industry or something, but they were, so, you've got intermediate products, you've got the logger goes out, cuts down the tree, takes it to the sawmill, sells it to the sawmill. The guy at the sawmill runs it into 2x4s, 2x6s, whatever, the lumber that they can generate out of those logs. They turn around, sell it to the construction company. Construction company builds a house. Let's say you've negotiated a contract, they build you a new house. They turn around and you sell you that house. Well, GDP only counts the sale of that house to you. It doesn't count those intermediate sales. So just always remember that. They did talk in the text about, some marginal calculations, but at the end of the day, even the marginal calculations, ends up ending, it is the value of that final sale that's counted in GDP. And see if there's something else I wanted to say there. And then also GDP, it counts production by anyone within the borders of a country. So if it is let's say Toyota. So Toyota builds a plant in Tennessee somewhere, or Honda, and they bring in some expertise, they bring in some machinery and some tools, but those cars are manufactured in the United States by individuals living in the United States, so within our borders, and those cars, so it's cars, could be medical equipment, it could be a lot of different foreign companies setting up shop here, but at the end of the day, that's counted toward our GDP. And so if it's Toyota, it's not counted by the country and in the Orient. It may be their brand name, but they aren't producing it. So it's going to be counted in the GDP of those individuals within the borders of the country in which it's produced. And I think they also talked in the text maybe about Japanese company using an accounting firm in New York City to do tax work and stuff. So the accounting firm's work is being calculated here as GDP, even though it may be for a foreign country. So just always remember, the GDP is counted in the country in which the service is generated. And that's kind of a difference between GDP and some other calculations that have been proposed over time, and most companies have moved away from them. And so we're starting to kind of move some simple concepts, some simple formulas in GDP. And if you think about GDP, it's consumption, investment, government purchases, net exports, fairly straightforward formula, plus, 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 plus. As you start to get into some of these other chapters, the formulas may get a little more complicated. And as you think about it, if you've got an equation, and just think about your basic math equations, you've got maybe an unknown on the left-hand side of the equation. On the right-hand side, you may have two variables divide, one divide numerator, denominator, one divided, or you may have a, multiplication or an addition. And just remember, especially if it's a single variable on one side, and it's set up as an equation, and on the other side, you've got numerator, denominator, you can cross multiply and play around, and, you can do some math magic and restructure, recombine terms, if that makes it easier for you to understand the concepts. Because as you start to move into inflation, unemployment, the formulas get a little more intricate, let's say, and you may have to spend some time actually thinking through the relationships of the variables in those formulas. And if you've got a formula that's got 3 or 4 variables, let's say it's got 4 variables in it. If you've got a formula with 4 variables in it, and you know 3 of those variables, you can always solve for the 4th one. And if you've got a formula that they're asking you if one variable changes, especially if you've got numerator denominator, and they start asking you, well, if such and such happens, and what's going to happen to the unknown. So if something happens over here, what does due to inflation? If something happens over here, what happens to unemployment? Just kind of you need to just start taking a step back and thinking through the formula, the mathematical relationships. And if you don't always have all of the information that you think you need, you can play around and make up some numbers and put in there just to see how the relationships change. So just kind of keep that in mind as we kind of move forward. We're talking about real income and that was, I guess, at the start of chapter 6. Talking about real income is just nominal income divided by the price level, and is the price level goes up, so your denominator gets bigger, the real income comes down, assuming that nominal income stays the same. Again, remember how economists function: ceteris paribus, all other things equal, nothing else changes. So if you've got the formula real income, and it's on one side the equal signs, and on the other side is nominal income and the price level. If somebody asks you a question, says, okay, if price level goes up, what happens to real income? If nominal income stays the same, then if price level goes up, the denominator gets larger, right? The fraction, let's call it, gets smaller. And so you can think through it that real income is actually going to get smaller. So price level goes up, real income goes down. Price level comes down, real income goes up. And that's kind of the way to kind of think through those formulas. We also went through the equation of exchange, the quantity of money times the velocity of money, how many times that dollar bill spins through the economy, buying and selling, and the exchange, equal to the price level times the potential output. And so the price level and the potential outputs really, you can kind of think of that as GDP on one side, and you've got the amount of money and the velocity sitting over here on the other side. And then you start talking about inflation, deflation, hyperinflation, stagflation. We went through all of those concepts and those definitions. But as the price level goes up, so think over here, price level, as the price level goes up, what happens to kind of the value of currency? Price level goes up, value of the currency goes down. Price level comes down, value of the currency goes up. And then we talked about indexing. And basically what happens on indexing, you're trying to keep your purchasing power constant. One of the best examples of an index is Social Security. So the government adjusts Social Security payments, I think, at the first of the year each year, based on their perception or their, looking at historical price levels and inflation and what they think is going to be in the future. They're going to adjust that so that those individuals receiving Social Security payments, or again transfer payments, receiving those Social Security payments, they're trying to keep that purchasing power constant. And also remember, as we kind of went through some of these, they start talking about. And remember, we talked about, delta, the little triangle. It's the Greek level, that it's a Greek letter in the alphabet, delta, and it means a change in. So, and so if you're looking at the percent change is equal to the new value of something minus the old value of something divided by the old value of something times 100. So times 100 gets you out to a percentage. And that's the way you calculate percent change. And then you're talking about calculating a lot of these variables, a lot of these metrics based on information and the number of data points. So the more information you have, the more data points you have, more than likely, at least in theory, the metric is going to be more accurate. And then we also talked about a price index, and we've got CPI, you got CPE, you've got the price deflator, but a lot of them thrown out there. But the price index is basically the current year cost of the market basket divided by the base year cost of the market basket times 100. CPI is the one, again, the talking heads use most often. Downside of CPI, I don't want to say it has for the most part, has a fixed market basket. It does change the market basket periodically, but unlike the PCE and the implicit price deflator, they adjust those market baskets in their calculations to try to better estimate or provide a sense of reality that's driving the consumption patterns of the population that they're surveying. So if you stop and think about it, while the CPI is the one that most people read about, most people understand and can relate to, it's the one that you see a lot of times in contracts. They will adjust contracts. We're going to adjust the price or the wage of next year's contract based on the piece, CPI. It is somewhat an issue because it is somewhat of a fixed market basket. So that means there's more than one issue, but that's definitely an issue, is that fixed market basket. And then again, if you think about it, so you've got a price index equals to the current year cost of the market basket divided by the base year cost of the market basket. And so 3 variables, if you know 2 of them, you should be able to calculate that third one. And because it's set up as an equation, you can actually rearrange terms so that your equation looks like the price index times the base year cost of the market basket equal to the current year cost of the market basket, and then you can multiply it by 100 to get a percentage. I think that's all I need to talk about there. Just quickly, the implicit price deflator, it's the nominal GDP divided by the real GDP times 100. So, and you multiply it by 100 to get it to a value that you typically see, I guess, expressed in the news, or again, the Wall Street Journal, or if you're reading some other economic articles, it's multiplied by 100, gets it to a number that they can actually see proposed. So, but also occasionally you will see the implicit price deflator, I guess, expressed as a number that hadn't been multiplied by 100. So you can see it. Let's say the price deflator is 1.5, and so you may see it expressed at 1.5, or you could see expressed as 1.150. So you're multiplying it by 100. You're moving that decimal point 2 spaces to the right. So just remember, you may see it in 2 different formats. Either the ratio of nominal GDP to real GDP, or you see it as a different number, a different metric, because they've taken that ratio and multiplied it by 100. So just be aware of that as you move forward. Also, remember, inflation is an average price change, and prices in any given year, and it's the average change of the price levels. And when we're talking about inflation, if you remember when we were talking about the individual markets, we were concerned about, price movements of a given item. So, and as you had those price movements, demand curve sloped down on those individual markets, and that's because there was a substitution effect and an income effect. So substitution effect, let's say we're looking at pork and beef. So price of pork goes down, and it's that demand curve sloping down at lower prices, more pork's going to be required, or more pork's going to be demanded because it's at a better price point than beef. So there's your substitution effect. And as they're paying less for the protein that they are including in their daily meal menus, it's going to increase income and going to make individuals better off because now they have more income to spend on other items. And then also, when you're looking at inflation, you're thinking about a positive rate of change typically. If it's inflation, it is going to be a positive rate of change. If it's deflation, it's going to be a negative, rate of change. An index is, with a fixed market basket. Again, we talked about the fixed market basket and the implicit price deflator, the PCE. They adjust their market baskets, CPI adjusted on occasion, but not nearly to the extent the PCE and the implicit price deflator do. If you've got a fixed market basket, it either typically overstates inflation or understates deflation. And issues with the fixed market baskets, you've got a substitution bias, which is probably the largest one. You've got a new price. So with that substitution bias, they don't take into account the relative prices of other goods and services. You've got a new product bias. So, the iPhone or, comes out, or to come out with a new iPad or something, that's a new product bias. There's a quality change bias if you've got that fixed market basket because you're not taking into account the improvement in quality. And then lastly, you've got the outlet bias, where then the one I typically think about. So if you find yourself with it's not allowing the market basket to adjust for consumption patterns, then the ones I typically think about are you've got Trader Joe's and you've got Aldi's. Trader Joe's and Aldi's owned by two different brothers from Germany. Trader Joe's more expensive. Aldi's, from my perspective, just as good a product, a much more affordable product, but that fixed basket doesn't allow you to take into account that's what they call outlet bias. Again, go back to the equation of exchange, where you've got, quantity of money times the velocity of money equals the price level times the output. And if you remember, we went back and down toward the end of that chapter, we started talking about you can either use that equation and go through the gyrations and multiply. You may have to do some division, but if you flip it and look at just the percent rate of change, and you turn that equation into the percent rate of change in M plus the percent rate of change in V equals a percent rate of change in P plus the percent rate of change in Y, now you've got to me, a fairly straight calculation. And if so you got four variables. If you know the values of three of those in percentage terms, you can calculate that fourth one. And so to me, rather than have to worry about multiplying and dividing, I like the one that's percentage change, because all I've got to do is I've got to figure out the value of three of them. If I can figure out the value of those three, I can pop those into that equation and I can calculate the value of that fourth one. So just keep that in mind. And then we move into kind of the unemployment section. And the rate of unemployment is equal to U divided by E plus U. And what happens is, the BLS, Bureau of Labor Statistics, similar to, Bureau of Economic Analysis, which doing some calculations on, CPI and some of those indexes, but Bureau of Labor Statistics, they go out and they survey, thousands of individuals, every city across the United States. And they're asking them 3 very specific questions. And if you remember, there's a flow chart in the book, kind of a decision tree. First question is, are you employed? If you say yes, then the decision tree stops. If you say no, then they say, have you tried to find a job, or have you been actively looking over the last 4 weeks? And then at that point, if you say, yep, I have, I've been scratching, I've been looking, I've been sending out resumes, but I haven't gotten anything, then there's the second question. And then the last question, they will ask you some, questions about why you're not in the labor force. So those are your 3 options. So you're employed, that's an E. If you're unemployed but have looked in the last 4 weeks, that's a U. And everybody else kind of falls out of the labor force, because the labor force by definition is the employed individuals and the individuals that are unemployed, but they're looking for jobs, and they've been actively looking for jobs sometime within the last 4 weeks. And again, if you know one of the variables, you can always turn around and calculate the others. So again, it's fairly simple. You can rearrange terms, you can cross multiply, but the key to it is figuring out, if you can figure out the labor force, and you can figure out those individuals that had raised their hand as employed, then you can figure out the unemployed piece of it, because the labor force is just equal to the employed plus the unemployed. And if I know the labor force and I know the ones that are employed, it's easy to find the unemployed. And then you can actually calculate the unemployment rate by plugging numbers, and you're plugging and chugging. So just always remember that in that survey, those that you're either employed, you're unemployed, or you've got that bunch that's not in the labor force, and it's some people don't want to work. Some people don't have to work. Some people are just disenfranchised, disappointed, disillusioned, and they've just filled out so many applications, sent out so many resumes, and they can't get a job. And they just say, they pack it in. They say, well, I'm just going to try to live off the government dole, and I'm just not even going to try to work. And then you've got those individuals that they are employed, but when the government asks them if they're employed, they don't raise their hand. And they talk about in the text about gambling, drugs, prostitution, a lot of nefarious type occupations, but you've also got maybe non-nefarious occupations, individuals that don't raise hand because they don't want to pay taxes. And heck, I don't want to pay taxes. But you've got individuals that the kid down the street that mows my yard, several of the neighbors in the neighborhood where I live have guys that come in and take care of the landscape work. They came in and serviced their swimming pool. So even if if they're paying them cash, the chance of them ever reporting that on to the IRS is slim and none. And Slim's just left town. So it's and then even if you pay them by check, you don't know whether they're declaring it on their taxes. So you've got this underground economy that sits out there with a lot of people that are working, and because of that, it creates a huge problem when it comes to calculating unemployment rates. And if you think about the unemployment rate formula, so it's U over E plus U, and if U is going down, so you've got something in your numerator decreasing, you've got one component in your denominator decreasing, and at that point, the unemployment rate is decreasing over time. So so unemployment's kind of counter-cyclical. And again, when you're fooling with these formulas, just take a step back and think through it, because it's basic math. You're talking about a ratio, and you just have to understand how those variables in that ratio move. So always just take a step back, and if you don't have numbers in front of you, just plug some numbers in and start changing them around, and just to see how things change. And as I said, it's unemployment's counter-cyclical. If the economy's booming, unemployment's probably going down, or the rate's lower. If the economy's not booming, if it's sluggish, we're in a recession, you're going to see unemployment increase. And again, when you're looking at the formula for the unemployment rate, just think about what impacts each of those. The individuals raise their hand that say they're employed, or those individuals that raise their hand say, I'm not employed, but I'm really looking and I really want a job. So just think about impacts to the economy and how it's going to impact those individual variables. And then we jump into, they talk about the actual unemployment rate and the natural unemployment rate, or the natural rate of unemployment. The natural rate of unemployment is the frictional unemployment rate plus the structural unemployment rate. And if you remember in class, we were, at least in the video, talking about frictional unemployment rate, and to some extent structural. It's going to constantly happen, and it's a sign of a dynamic economy, and to some extent frictional unemployment's good. Because frictional is you're just not being able to match jobs. Somebody downsizing, get laid off, they're fired, they want to work, they can't find that right job because there's not a lot of information, the necessity or the necessary information available to them to get them hooked up with that next job. Even though you've got LinkedIn and Monster and Indeed and the government agencies provide just a wealth of information on jobs, for some unknown reason, you just can't get people hooked in. You also see it in recent college graduates. Go to, pay X number of dollars for a degree that they think is going to make them a bazillionaire, and they get out of college, and that degree is not what the economy is looking for at that particular time. So they have trouble matching and trying to find that perfect job. And then you've got structural unemployment, which is typically what happens is individuals are laid off, there's a downturn in the economy, the entity they're working for goes out of business, and their skill set, they have trouble matching that skill set to what employers in the economy are looking for. And in that situation, it may be they need to go back to school, they may need to get some kind of recertification, probably need some retraining. And so that's on the structural side. So frictional, it's more of an informational driven matching opportunity. Structural, it takes some retraining. And so it's the frictional and the structural forms the natural rate of unemployment. Actual rate of unemployment, it's the frictional, the structural, and it's the cyclical piece. And you see cyclical unemployment. Remember what the business cycle looks like. Expansion hits the peak, starts down on a recession. It's in that recession area that you're going to start seeing that cyclical unemployment. Companies start laying people off. They could reduce the nominal wage, but very few do that. They just find it easier to lay people off. It hits that trough and starts back up on the expansion piece. And some of these cyclical individual or cyclical unemployed individuals are going to jump back into the market at that point because it starts to expand again. So cyclical you typically see during the recession portion of that business cycle. See if there's anything else. If you've got typically, when there is unemployment, it's not necessarily, COVID was a unique situation and it's somewhat extended some of this unemployment. But typically, before COVID hit, if you raise the nominal wage rate, then unemployment fell. Again, if you reduce the wage rate, then unemployment popped up. But at the same time, I'm seeing, and I'm not sure, I don't know whether that still holds. I'm not sure what that wage, that perfect nominal wage rate is at this point in time that's going to clear that market, because I see a lot of fast food restaurants here in Atlanta offering, $18 an hour, free food, come in and work. And that seems like a lot of money to me, to work fast food. Maybe not a lot of skills are needed. You see, there's a truck stop that I don't know what they call themselves, a truck stop, but the outfit's called Buc-ee's, and stop at one stopped at several, but I stop at one between if I'm going from Atlanta to Nashville, and stopped the other day to get some gas, and I'm looking at, they're talking about the benefit package if you want to work at Buc-ee's, and they're talking about $22 an hour, 3 weeks paid vacation, talking about, I think they said they matched your 401k benefit dollar for dollar or something. I mean, it was a benefit package that I found extremely unique, and I don't know whether having employment issues or not, but you kind of wonder why. It's this group of individuals, so they don't fall in the employed group, they don't fall in the unemployed group, they're in that group that's out of work. And what's it going to take to get them interested enough to come back into the job market? And again, don't forget, the natural rate of unemployment is frictional plus structural. The actual rate of unemployment, frictional, structural, cyclical, takes a 3. And then we were talking about, and it may have been in chapter 4, where we were talking about price floors and price ceilings, and talking about a price floor, which is the minimum wage rate is considered a price floor, and that price floor has to be set above the equilibrium wage rate. So for it to be effective, it has to be set above that equilibrium wage rate. So just keep that in mind as you start to think about wage rates. Anything else? I think that's all on that piece. And we'll go back and we're kind of get into this last chapter. And some students have, I don't want to say a lot of difficulty, but some students have some difficulty, some degree of difficulty, when they're talking about aggregate demand and the long run aggregate supply curve. So remember, GDP was consumption plus investment plus government's purchases and net exports, and the 4 sources of aggregate demand are similar: consumption, investment, government purchases, net exports. And if you start to think through some of that, and we'll go back to price level. So you're talking about the relationship. We talked about in some of the earlier chapters, the relationship between price level and income, price level, wealth, what happens to consumption spending as price levels increase, then the real wealth or the real income decreases. And so as real wealth decreases, consumption spending may start to decrease too. So consumption spending tends to move in the same direction as real wealth or real income. So just remember, price level going up, real wealth goes down. Price level down, real wealth goes up. And it impacts the consumption or the consumer spending because it gets to the point, it's expectations at that point. They see the price level rising and they're sitting there trying to figure out, what does the future hold? Is the market going to move to that equilibrium point that's going to clear the market? And at that point, does the price level take care of itself? Or is Uncle Sam going to step in and do something that, to either improve the situation and put a control on the price level, or they're going to just screw things up worse than they are now? So it's that understanding the future that's going to drive this consumption spending. And it's kind of the same thing with if you think about net exports, as the price level goes down, net exports go up. And so why do you think that works? So if you think about it, price level goes down, what do we say happens to the real wealth? Price level goes down, real wealth goes up. What happens to consumption spending? Consumption spending, as the price level goes down, real wealth goes up, consumption spending goes up. And the way it impacts net exports is you have individuals in the United States start buying more and more domestic products. They buy more domestic products. They buy fewer imports. So remember, net exports is exports minus imports. So you automatically know imports are going down. And at the same time, price levels going down, our goods and services look a lot better or a lot more economical to foreign countries or foreign consumption. And so they start buying more exports. So if that price level starts to go down, it's going to drive, or typically it's going to increase domestic spending, which is less reliant on imports. So the imports fall in your equation. And it also looks attractive to foreign countries, foreign investors, and they're going to start buying more of our exports. Exports are going to go up. So net exports are going to increase because of two things: exports going up, imports going down. So makes sense? Just remember, think through how those changes in those price levels work. And then we get into why the aggregate demand curve is downward sloping. And remember, in individual market, it's the substitution effect and its income effect. And it doesn't apply here with aggregate demand, because in aggregate demand, you're talking about the aggregate demand not in a single market. You're talking about the entire market of a nation. So there's not that much change with respect to relativity of prices. All of the prices are moving and heading in either the price level is going up or the price level is going down. So you don't have that same impact. So what happens? Why is the aggregate demand curve downward sloping? We talked about it. So as price level goes down, what happens to real wealth? Real wealth goes up. And so same thing. If price level goes down, money demand goes down and interest rates go down. And what happens when interest rates go down? you have investment spending that goes up. So prices or the price level drives investment spending because you've got all these firms, corporations sitting there trying to say, do I buy today based on what I think the future demand for my services or goods are going to be, or do I wait and see what the economy is going to do? So prices are going to drive that investment. And then you've got the international trade deficit. As price levels go down, exports go up. We talked a few minutes ago about that. Exports go up. You've got imports are going to come down, and net exports are going to bump up. And again, as we've talked about, there's an increase in domestic spending, and there's an increase in foreign purchases. So net exports are getting an advantage twice. Domestic spending's driving imports down, or the demand for imports down, and the price level being down, things look more attractive to foreign purchasers. And what you've got in, so if there is you're talking about aggregate demand, you're talking about things at all price levels. So a shift in aggregate demand means that aggregates, it's down sloping curve. A shift in aggregate demand is going to shift in this direction if there's an increase, going to shift in this direction if there's a decrease. Think about what price level is going to do to that, and think about what price level is going to do. And it's a increase. The shift is an increase at all price levels, not just one or two. It's an increase at all price levels or a decrease at all price levels. Again, remember, think about what price levels are going to do to consumption, investment, government purchases, net exports. And then we get into the long run aggregate supply curve, and they talk in the textbook about it's essentially, vertical. If you think about the individual markets, it's an upward sloping curve, got demand down, upward sloping. Now you've moved into the economy as a whole, aggregate demand's down, but you've got aggregate long run aggregate supply curve sitting here vertical. And that's because it's not as affected by, so much price level. And why is it not affected by so much on price level? You've got buyers and sellers, expenditures, incomes, and they're offsetting, I'm going to say negating each other, but as price levels go up, it's going to impact the buyer and the seller. As price levels go up or down, it's impacting expenditures and income. And so it's sitting there vertical at the real GDP. So it's sitting there, you can call it the real potential GDP. You can call it the potential level of output. You can call it the full employment output. Any of those three terms is where that long run aggregate supply curve is going to sit. And at equilibrium, it's going to continue to shift and continue to readjust itself, even as things change. So there's, we talked about demand shocks and supply shocks. Even there's shocks to the economy through equilibrium, or as the economy moves back to equilibrium, it's going to settle back at that real GDP, maybe at a higher or lower price, but it's going to settle back at that real GDP, or the real, full employment output. And as I talked about, in the long run, as it drives back to equilibrium, to get the long run to really work, we have to assume prices and wages are flexible, so real GDP moves to potential output. Probably not a very valid assumption, but in the theory of the long run, that's what happens. The natural level of employment and the potential level of output, that's where equilibrium settles, and it moves to the natural rate of unemployment, so that you've got only frictional and structural unemployment, because in the long run, it gets rid of cyclical unemployment. Cyclical unemployment takes care of itself as it moves back to equilibrium. So now you're only left with frictional and structural when you're talking about the natural rate of unemployment. And that's because those are just things that happen, I don't want to say continuously, but they're a result of a dynamic economy. And then, macroeconomists they've come up with this short-run aggregate supply theory or model, and it is useful in that the way macroeconomists explain how deviations of real GDP from potential output occur. It's the opportunity, and if you go back and read the text, they have gone through multiple, you've got, they talk about the inflationary gap and recessionary gap, and the short run aggregate supply curve. It's a model that helps explain those shocks to the system and how those shocks to the system adjust over time to get back to long run equilibrium. And again, we talk about wages and prices are sticky, and those wages and prices are sticky in the short run. So they just don't adjust that quickly. And that's one reason that the short run aggregate supply curve, that type of model, helps the theory in macroeconomics to explain, I mean, again, based on sticky prices and sticky wages. They're extremely slow to adjust. And then, why do we have, let's talk about wage stickiness. Why do we have wage stickiness? We have wage stickiness because of labor contracts. A lot of union contracts that I've been involved in the past, they're 3 to 5 year union contracts. It's hard to change. You got a contract like that, and it's it kind of etched in the stone. It's extremely difficult to get those wages to adjust in it's not going to adjust in the short run. A lot of those, union contracts would have a cost of living adjustment, tied to the CPI. And you see, if you think about 2020, trying to think, if you had a contract with a 2% CPI adjustment for 21, 22, 23, let's say those 3 years, a 3-year contract, and it was based on, and the CPI, had been plugging along, and inflation rates had been like, I don't know, somewhere 1 to 2%. That 2% looked pretty good when it was negotiated in 2020. But then what happened to the inflation rate in 2021? It bumped up to what, 7+%. 2022, it was still sitting there like it's 6% or something. Last numbers I saw for 2023, it was down maybe 4%, a little lower. So if you were in the union shop and you had that, 2% bump up each year, I mean, heck, that was a terrible contract. At the time, it looked pretty good based on historical inflation rates, but doesn't look so good now. So that's where, the wage stickiness comes in with those, with those labor contracts. And also their institutional effects. Could be culture, could be expectations. Let's just take minimum wage. Again, we're talking about a price floor, and you set that minimum wage above the equilibrium wage rate, and it's going to be extremely difficult to get to equilibrium unless something is done with the minimum wage. And then we want to talk just a few minutes about price stickiness, and they get back into there and they talk about menu cost, just the cost of adjusting prices. Some companies try to hold price adjustments to, 1 or 2 times a year. They don't want to alienate their consumers. They give examples of like Land's End and LL Bean and, restaurants that, there's a cost to regenerating and adjusting those prices. When you're talking about healthcare providers, it's not hardly as difficult because they have things built onto a charge master. And unless the contract with the health plan limits the amount of adjustments that they can make in that charge master on any given year, they can just keep pumping that charge master up and keep increasing bill charge. And so, no wonder the healthcare costs are blowing through the roof with no way to manage the impact of things like increasing the charge master. You've also got price stickiness on long-term contracts. Producers have long-term contracts with individuals that are going to purchase their items, their goods and services. They've also got long-term contracts potentially with individuals that are going to provide them factors of production. So you've got long-term contracts going to impact that price stickiness. And then lastly, you've got these institutional effects, you've got regulations, you've got laws that limit, price movements. Some countries have very strict guidelines on, how prices can change and, can you change the individual products that you're are producing, especially when it comes to quality, can you change any of that? So that's what you're talking about, and that's what's going to impact price stickiness. That's going to wrap it up for me as far as the review that kind of have gone through when we're looking at chapters 5, 6, 7, and 8. Been some interesting chapters. I think what you found, at least I hope you found, is what you learned in chapters 1 through 4. You could take and put together and start to make some sense out of it, and watch how they flowed into chapters 5, 6, 7, and 8. GDP, inflation, unemployment, aggregate demand, long run, aggregate supply, short run aggregate supply. And you'll see how the economy is starting to take shape and kind of how it's all starting to pull together. We did talk a little about policymakers. We haven't gotten into it too much. But policymakers through monetary and fiscal policy have a huge impact on the economy, because the policymakers want the economy to keep plugging along, keep providing, maximizing welfare, maximizing utility for the population in any given nation. So want the standard of living to continue to increase. But that's going to wrap it up for 5, 6, 7, and 8. And next time I see you, we'll be talking about, I guess it's chapter 9. Talk to you soon. Thank you.